Hi, everybody. It's Elliot Began, and this is another episode of TIG Talks, the podcast taped in front of a live virtual audience, which is you. Before we jump in, as always, a bit of housekeeping. This is a podcast that features your questions. We want to answer the things that are top of mind for you and give you actionable advice and things that you can take back to your businesses today and use. But that only happens if you ask the questions. And so as a reminder to do so, it's very, very simple. You just go to the lower corner of your screen and you'll see a box that says Q&A. Please type your answers in there and we'll do our best to answer everybody's as quickly as we can and get through all of the questions. You can also use the chat box to send us any messages as panelists, and we can try to respond. Everything that we share here will be part of the podcast episode that will come out. Many of you who are listening to this are doing so on the podcast. In the show notes will be all of Heidi's contact information and all of the things that you need to know. And any of the links and things that we mention here today will be there as well. So with that, I'm going to introduce Heidi and let her tell us all a bit about herself and AVL Growth Partners. So Heidi, thanks so much for joining. Glad to have you here. And please share a bit more.
Yeah, absolutely. Thank you so much for having me. I'm pretty excited about our conversation today. I am what is called a fractional share CFO with a company called AVL Growth Partners out of Colorado. And what we do is we create a full suite of finance, accounting, and strategy, anywhere from services at the accountant level all the way up to CFO strategy. And so I do spend quite a bit of time working with food brands. I do work in a few other industries, but I would say 70% of my focus over the last 10 years has been in the food industry, the natural food industry. Both for companies that co-pack and manufacture, and have just really enjoyed helping these companies grow and mature and kind of navigate what is being a food company.
And so a lot of people, the first question is, why the hell are we doing a podcast on accounting? That's like better than melatonin. And I get it. That's how many of us react. But there are those of us who are kind of nerds, and we actually do enjoy, spreadsheets and numbers and so forth. But in all seriousness, it's a topic that we don't discuss enough and talk enough about, especially for early stage brands. The importance of having rigor and discipline around your numbers, around your accounting, around your financials. It impacts everything. It impacts your ability to make good fact-based decisions. It impacts your ability to foresee potential cliffs or challenges. And of course, it impacts your ability to fundraise, because not only do you need good numbers to identify what it is that you need to raise, but as you go through the due diligence process with any potential investor, the quality and the clarity of the financials you put in front of them often become the deciding factor as to whether you get that funding or not. So that's why it's important to discuss it. And there's more than just, calculating EBITDA and gross margin and all of that. These are often the KPIs that are your roadmap and your indicators of how you're doing, how you're performing, what's going, and so forth. So that's why. But if you choose to use this episode as melatonin and it gives you all a better night's sleep, then I consider that a job well done too. So totally up to you, no pressure. I do have the voice that have put many to sleep, so I get that. I'm going to just start things out, Heidi, if I may, and just kind of ask a question in terms of best practices for early brands and what they should be at least having as a bare minimum regarding financials and rigor around financials.
Right. For emerging brands, it's really important that you start off early with recording your data set, and your data set are your transactions, anything from your accounts payable to the way you're recording your inventory to the way that you're creating your invoices to your customer, making sure that you have a good nomenclature, a standard way of recording information into your finance system, whether it's a Xero or QuickBooks or whatever accounting software systems that you have, really thinking long-term about how you're recording that data and what standardization are you doing, because that data helps you create your roadmap. It helps you find your trends. It helps you understand the story of what your data is telling you, how well your company is doing, where there's issues, where there's not. So recording that data and looking in a standard way, and then looking at it month over month and really understanding what it's telling you is, like you had said earlier, going to give you that roadmap, but it starts with the data. And that's where we tend to see issues happen when brands finally come to a company like mine or others, that the data set is so messy that we can't make heads or tails of really what's happening within the company, so that we can come up with a strategy of, scale and growth and sustain, and where we need to invest, and where we're overspending. So really paying attention early on to that data set and really looking at your historicals month over month and understanding what's happening is going to create that roadmap for you that's going to allow you to be successful much quicker, because it's the concept of junk in, junk out. If you're making decisions based on bad data or incorrectly recorded data or missing data, you could make some missteps that could, create issues for your velocity, or you could be taking in credit memos and discounts that really aren't yours to take. And how is that impacting your financials? Are they too big? So really, when we start with the early stage brands, that's the one thing that is something that they can do even on their own early on, if they can't afford, like fancy accounting, is just make sure you have a standard way of putting your data in the system so that you can pull it out and understand what it's telling you. And it's the same every month. You didn't do it one way one month and a different way another month. So I would say that's what differentiates brands early on.
So would you recommend that one of the very starting blocks is actually to establish a good chart of accounts and clarity in terms of what are the buckets you're going to be filling with the different information, and how you're going to label and operationally define those buckets?
Absolutely. If there's one area that if you invest a little money early on is reaching out to others in the industry and make sure that you're setting up your chart of accounts in an industry standard way. Food manufacturing is very different than a lot of other industries. And so it's really important that even if you invested some time or even a little bit of money, to make sure that the chart of accounts you are setting up is correct for this industry and what you're trying to accomplish, that will help you immensely in the long run.
And one of the things I see is that a lot of early stage brands take what I call the ostrich approach to accounting. They stick their head in the sand and hope to God they never have to see their numbers because they're scary, and because they're a reminder of the risks that they're taking and so forth. And I always try to encourage founders to think of it the other way, that numbers are freedom. They give you choice, they give you visibility and so forth. But Heidi, how would you kind of share with entrepreneurs about how they should view numbers and view the data and view the importance of having this to be better founders, better entrepreneurs?
Right. And that's where the starting point becomes what I talked about earlier, is how you enter the data in. Data is really important because it is the story of what's happening in your company. You need the historical data, and you need to be looking at what's behind you and what's been happening, and looking at any trends, any things where you can see things that are occurring at the same time, or things that have a lot of variability, and trying to make heads or tails around why that's happening Is that the way it should be? Is there a reason it's happening? Is it a timing issue? Is it a data issue? You have to understand what's happening historically in your company so that you can take that information and create a forecast and look into the future. And the way that I kind of describe the need for good data, good financials, is like driving a car. So when you're driving a car, you do have your rear view mirror. It's a small piece of glass, but it still is really important to be looking behind you and seeing what's happening behind you and educating yourself. What's going on back there? Do I need to be aware of something? Is someone gonna, hit my bumper, whatever it may be. But where we really need your vision is through the biggest piece of glass, which is the windshield. That's where you're making a lot of decisions as to where you're going and educating yourself when you're driving or when you're looking at your financials. So using your historical financial data to be able to create assumptions or theories about where you think that your company is going. And then from there, creating a forecast at least 24 months out. I know that really early stage, that's really painful because there is a lot of guessing. But using that historical information will allow you to create a baseline of assumptions of where you think it could go based on kind of your best understanding of what's been going on. And then that's what really allows you to understand what your needs are going to be in the next 2 years. Is that a cash need? Is that a CapEx need? Is that more resources, headcount? If we don't, invest in a salesperson, do we really think we can get that top line revenue? That forecast is going to really paint that roadmap and that picture of where you're going to go. It doesn't mean that there's not a pothole up there, that yes, you didn't anticipate. There's always things in front of you that you couldn't have anticipated. But if you have a baseline of assumption, it allows you a better understanding of how to move around any of the hurdles or pitfalls or changes, that occur. A lot of early stage companies that I work with, obviously COVID being one of those, was really interesting time. But because we had solid forward assumptions, we were able to pivot and manage, in that situation a lot better than some of the other companies that really didn't have that forecasting component and using that data to drive their business forward in a proactive way rather than just simply reactionary.
I think that's such great advice. And of the many the regular soapboxes that the regular listeners to this podcast know that I stand on, one of them is just that you have to basically build a growth hypothesis of where your business is going to be, including revenue sources and key expense buckets and capital needs and from working capital, et cetera, for the next 5 years, really, to be able to plan appropriately. And so it's good to hear that. Plus, now I know, I always thought that little glass mirror in the middle of it was to see what I had stuck in my teeth when I was driving. So that's
well, you can use it for that as well.
Okay.
Probably missing a few things, but how you look in your car is important.
Gregory has a question. Hey, Gregory, nice to have you here, buddy. What good resources exist for entrepreneurs to get educated on the quote standard way unquote that are these are brands that are bootstrapping and may not be able to immediately afford a fractional CFO?
That is a fantastic question.
Well, you expect nothing less from Gregory, trust me.
The thing is that there's no magic bullet, but on that, where it's like, here's a whole library of information on specifically what you need to do. But there are a lot of company or a lot of different organizations like a Naturally Boulder or an NCN or TIG Talks, where you're going to be able to get access to resources that are going to be willing to share a lot of information with you early on and be able to have access to a lot of those very basic beginner questions. That they host a lot of seminars on very specific topics like this. Like for food manufacturing, a simple topic would be, how do I manage my trade spend? And a lot of people are like, what do you mean trade spend? What does that look like, and how does the industry break it out? So there's a lot of opportunities out there, different communities that you can join typically, where they will funnel down into very specific topics that really allow you to understand what are the best practices. Because in all honesty, they're shifting and moving, especially in the natural food industry, quite swiftly a lot. And so being a part of not just one of those communities, but a few of them, and really tapping into them, there are a lot of heavy resources that it's a pretty inexpensive spend that will give you access to a lot of those very specific industry normalizing pieces of information and guidelines and best practice.
A couple, and that's great advice. A couple things to add to that. Bob Burke does a couple seminars each year on financing and numbers that I think is very detailed, very helpful. Another really good resource is fellow founders, people who are a little bit ahead of you in the process, because they've gone through the pain and suffering, so they know what's worked and what hasn't worked. And you'll find that many of them would be willing to share, basics, everything from chart of accounts to how they're dealing with, unifying KE deductions and et cetera. So don't be afraid to ask there. Of course, all of it has to be, there's the concept of GAAP. And so that's pretty specific, which is general approved accounting practices. And as long as you're following within those guidelines, you're in good shape. Here's another question. As an early stage brand, if I could only focus on a few things, what would, few things around accounting and numbers, what should I be focusing on?
Well, we've kind of covered one of the large focal points, which is it all starts with your chart of accounts. And I agree with you 100% on the food industry is very generous with their share of information and mentorship and really propping up other brands, which is awesome. And utilizing those individuals as mentors. So that's the nice thing. And so it kind of really goes back to what I talked about at the beginning, which is if you have a good solid chart of accounts and that's set up to industry kind of expectation best practice, and then you start to differentiate on the difference between, you just mentioned GAAP, Elliot, the difference between GAAP and cash accounting. A lot of early stage companies record their data based on when cash is moving in and out of their company, which makes it really difficult to find trends because it makes your financial results really lumpy. You can't figure out like what your margin is, or what were my COGS, my cost of goods sold, associated to the units that I sold, like because I just recorded all my raw materials and COGS on my P&L, but I didn't actually sell all of the units that were associated to those raw materials. So really understanding cash accounting versus accrual accounting, which is more of what you were talking about, Elliot, which is under GAAP. Accrual accounting meaning when was the revenue earned is when it hits your P&L, and when was the expense incurred. Not when you paid the bill. It's, I paid someone for services in November, but I didn't get the bill till January. I need to put in data into my accounting software in November to represent that spend, even though I don't have an invoice yet. When you start doing your data on accrual accounting, it's going to make your financials so much more informative and so much more powerful to give you that roadmap. So if you can do that really early on and spend the time reaching out to different people to discuss, like, how should I do this? What does accrual accounting mean? There's lots of amazing, quick YouTube channels that will give you kind of the down low on how to do that. Lots of resources. If you were to solely focus on chart of accounts and making sure that you're recording stuff on accrual basis, and you know what belongs on the balance sheet, meaning your inventory for stuff that hasn't been sold, for any invoice values that haven't been paid, for any expenses that you haven't been paid and you don't even have an invoice for, how do I get that on there? If you can just do those basics now, you will be well ahead of the game much earlier on, because you'll have data that's giving you a better roadmap earlier on. So if you had to say, hey, I can only focus on what are the 3 most important things, for me, that would be it, because the rest you can pivot and move and change and reorg. Those are the 3 critical ones.
Yeah, I'm going to add to that a bit. Well, first of all, I just learned that I have something in common with cash-based accounting, and that is we're both lumpy. But I think, a lot of people use cash-based and they look at it thinking that they're managing cash. And you just said something I think is hugely important. When you look at your P&L, an accrual-based P&L begins to help you see trends in your business. It also helps you begin to see the correlation between actual sales and actual COGS and real margin and all of that. And so if you have that to look forward, and that's your trend, and you'll be able to see how your business is performing period over period, this month versus last month, year to date versus year ago, all of that is hugely helpful. The other element, though, is your cash flow. And as Andy Whitman with 2X says all the time, cash is king. And there probably is nothing more important in the long-term ability of a brand and an early stage founder to succeed than their ability to be on top of their cash and know exactly where how much they have, where it's going, and where it's coming from. So speak a little bit to that, if you would, Heidi, about cash flow and how to track it, and how important it is to an early stage brand.
Right, absolutely. So it kind of goes back to what we talked about earlier, is having a forecast, because you want to be able to predict where your cash is going and know that if you've got a cash issue, how big that cash issue is, and when it's going to happen, what that period of time is. How do you forecast that? How do you understand that? How do you know that? You forecast out your P&L, and then your cash flow is essentially going to be when your balance sheet, when you're running P&L off of accrual, not cash in and out, but accrual, meaning there's going to be things on your P&L that you haven't expended cash on yet. For example, the best one, or you could have already expended all the cash and it's just showing a portion of it on your P&L. One of them would be investment in capital expenditure, depreciation coming onto your P&L. That's not a cash spend. You've already spent the cash, or maybe you haven't, because maybe you have a loan. So the way that you look at your cash is you take, okay, this is what I think my P&L is going to be. Now I have to look at my balance sheet and understand, where have you already spent cash, or where have you not yet spent cash? What are those increments and decrements? And so looking at your balance sheet and the changes in your balance sheet are going to drive ultimately where your forward cash is going to land. It starts with your P&L, but it ends with understanding future purchases of capital expenditure, future purchases of raw material, or if you're co-packing, what are the terms that I have on the co-packed material that I've procured to sell? Is it 60 days? So really being able to model that out on your balance sheet is going to ultimately allow you to understand when your cash might get tight and at what scale it might get tight, so that you can then really decide how you might want to go out and bridge that gap. Do you want to raise equity? Can you pull it off with debt? Do you want to do something that's called a convertible round, which is debt with the intention to convert to equity, so that you can get a little farther along and have a little bit better valuation? Really understanding and forecasting cash out at least 2 years is going to be super helpful in you having enough lead time to really put together what you want it to look like and how much you need, and what leads you're going to do, who are the type of people that you want to talk to, what are you pitching them, and how well do you know your numbers to support your pitch, to people. You don't want to not be paying attention to your cash and only looking at it in the month that you're in or in the past, and not really understanding what it could look like 18 months out, because fundraising can take a while. if you all of a sudden realize, oh gosh, we're out of cash in 6 weeks, it's going to be really tough for an early stage company to get debt. And even that will take quite a while. So you can't just be like, oh, I'll go get a line of credit. That's still going to take, even if you're able to pull it off, 45, 60 days to close on something like that. Typically fundraising, if you're going to do a priced round, an equity round, or a convertible note that would eventually go to equity, it's going to allow you the time that you need to get that secured and in place. There are some short-term things that you can do, like factoring and things like that. But a lot of times, if you just purely do the planning, you can be able to bridge those financial gaps without it costing you an arm and a leg. And that's that point of really looking forward and understanding what your needs are from a cash perspective.
Looking at your business and when you're going to run out of cash is no fun, and it's scary. I mean, it really is scary to confront that, but it's a whole lot better to do it in advance than to be at the cliff, because at that point, first, if you do anything, you're likely to make subpar deals, just because when you're desperate, you take deals that you necessarily wouldn't, or all you can do at that point is curl into a fetal position with a flask and hope to live another day. Neither of those are what's best for your business. So being able to foresee it and know and be realistic. And I'm a big proponent, those of you who work closely with me know that I'm a big proponent of, physically manually tracking your inflows and outflows routinely. So because the other thing that we tend to do is that, was it Gary Hirschberg always says that entrepreneurs are pathologically optimistic. And so we are, we do our cash flows and think that we're going to get cash in sooner than we actually do, and that our spend is going to be slower or less than it actually is. And the benefit of doing a projected cash flow and then putting your actuals down right next to it is you begin to unearth your own forecast error, your own bias, and you become better at seeing the reality and not selling yourself a bill of goods.
Yeah.
Lauren has a question, Heidi. Lauren asks, and by the way, if anyone wants some really bomb kimchi, Lauren, mother-in-law kimchi, very, very good. Anyways, you can pay me for that small commercial plug later, Lauren. Is there a good rule of thumb of how to budget and track for trade versus marketing? What about like Whole Foods 3% or early payment at the distributor of 2%? Do those go into trade or other sales reductions? What are the best practices?
Very great question. So you bring up several and they belong in different buckets, but ultimately the category that you just brought up is what it's kind of that gap accounting again. It's called contra revenue, and it lives up in gross margin right below your revenue from the units that you've sold. So it lives right below that, and they're negative numbers in that area of your financials before you get to cost of goods sold. So typically one of the ones you brought up is in the discounts, like 2% net 10. We don't really truly consider that true trade. We just kind of consider it a discount for doing business. So we do list it in contra revenue, but we do not, we don't put it in trade spend necessarily, but it is in that contra revenue. For me, and different CFOs view these things very differently. This is where it's more like art, not a science, as long as you have it up in contra revenue, the way you categorize it. There are some industry best practices where you have two different buckets for trade spend. So you have variable trade spend. That's the trade spend that's always ongoing, like you kind of talked about a little bit. Sometimes it's that 3% partner fee that you have from, Whole Foods. So in order to be able to sell on their shelves, you have to play the game. And so you have to have that 3%. That's variable trade spend, because as long as you have that relationship with that retailer, you're going to have to do off invoice discounts with them. You're going to have to do scans and promos. You're going to have to do their required 3%. And that's variable trade spend. You then have fixed trade spend, which is considered more like one-time trade spend. So say that you have a free fill that you're going to do because you're coming on all the shelves of Sprouts or what have you. That's considered fixed trade spend because it's a one-time concession that you're getting in order to get on the shelves. So that's fixed, and it's typically tied to opening up new points of distribution. You can also, if they pay you a slotting fee where you're either having to buy your way onto the shelves or get in their computer system, that's not a free fill of your actual product. That's all fixed because it's one time. Typically, sometimes there will be a few one times that you have. A lot of them have category resets, so you would have to pay it again, but we still consider it fixed because it's not quite this ongoing relationship of discounting that you're giving, like an off invoice, a scan, an MCB, whatever it may be, a spoils, freight allowance. Those are all areas that go up in that contra revenue account. And the best practice is to have a variable trade spend and a fixed trade spend, and then having sub information under that. And that's really powerful when you go to fundraise, because looking at trade spend is something that a lot of the savvy food investors really look at. They want to know how you're supporting the growth of your brand via trade spend. How's that impacting your ability to open doors, ACV, or velocities, the number of pulls off the shelf? So great
A lot
question.
of nuggets there. Of course, I've never heard accounting being referenced as an art. So kind of cool, a little frightening, but kind of cool. One of the things I think, well, a few things. First of all, this comes back to the very beginning of our conversation around the importance of setting up the rigor of a good chart of accounts, because that ultimately becomes the menu or the playbook in which you put expenses. When it comes to contra revenue, I mean, there's a and this is opinion. When it comes to any bucket, but in particular things like contra revenue, there's a fine line between parsing it out too much and therefore causing yourself more work and potentially more confusion, and parsing it out enough. You want to be able to see the things that you need to see in order to sell your, to one, make good decisions, and two, to sell your, your proposition as investable. And that, trade spend is one of them, and the allocation towards trade spend that is growth driven trade spend versus, other contra revenue like discounts, et cetera. And one of the things that is key, and this leads to another question in just a minute, which is how to really prepare your financials in a way that is going to position you well in front of investors. But before we dig into that, I want to get to, well, Lauren has a follow-up question, so let's just go there. Is there a quote unquote perfect range for trade spend?
Well, there is a way that it's viewed, and it depends on where you live in the store. Shelf stable tends to have less variable trade spend need than you would have if you're in the freezer. And then typically the refrigerated, because it's more perishable, tends to be the most expensive trade spend relationship. Just because of what they require to make sure that your product is truly moving off and through the shelf, because of where it lives, because it's perishable, it's expensive. There's not as much room in the grocery for it, where there's all these inner aisles of, shelf stable product. So typically there are some sweet spots there. It depends also on what phase your company is in. Early on, I always call it putting nitrous on it, because my son loves cars, and so everything in my house becomes a car reference, and it now bleeds over into my job. But we call it putting nitrous on it early on when you're really trying to get velocities. If you're let's just use I can just kind of give you benchmarks. Early on, we kind of view best practice when you're really trying to get velocities and stake down your claim on the shelves of retailers. Usually if you're shelf stable, you're somewhere between like 15, 18, 19% is a really healthy spend. A lot of companies can spend a lot less, but their velocities and growth will most likely be a lot slower. And so if you don't have the cash to really invest to get you up, or the margin on your product to really be able to give that concession of 18, 19% of your top line sales to trade spend, you can do it. It just kind of slows the velocity. That's why we call it nitrous. Typically, if you're in the freezer, you're looking at somewhere between 18 and 22, 23% tends to be a nice guideline. And then again, if you're refrigerated, it's the most expensive engagement, and you're somewhere between like 20 and 28. That one just it just depends on what your shelf life is on your refrigerated product. There's a lot more variability, but it is the most expensive. And again, you can spend less. It just kind of slows that velocity, and so you need to be prepared for that. And when I say percentage of it's of top line sales, when I'm giving you percents.
A couple of things to add to that. First of all, Lauren, I'll answer your question a little bit more directly. No, there isn't the perfect range. There's a lot of moving parts to it. Category for sure, all of that, but your pricing architecture, and that's where a lot of brands miss the opportunities to really think through what their pricing their architecture is. If you know you're in a category where upwards of 70% of the volume in that category is done on deal, then you really need to build in your pricing architecture that model. And that may mean that your everyday white tag price is higher than ordinarily you would think, but you're not going, if you're in a 70% plus VOD category, you're likely not going to spend much time at your white tag price anyways. And if you're at your white tag, it doesn't really matter, because when you're off promotion, you're going to be surrounded by other people on promotion. So it's only going to be your most loyal customers. So you got to think pricing architecture first when it comes to trade spend, and then you've got to look at the category you're playing in and what's the better structure. So there's just a lot of moving parts. And what I find too often is that brands come out at what they think their price needs to be, or their competitive price point, and then they get into the promotional rabbit hole and start going down there, and then they wonder why their gross margin just sucks. And it's really that. So know the category dynamic first. I mean, for example, the ice cream category. I mean, the ice cream category is probably, and I don't have the numbers in front of me, but I would guess the volume on deal somewhere like 90%, and the switchability, meaning the willingness of consumers to go from brand to brand to brand based on ads, is very high. And so if you know that going in, you have to kind of buffet yourself for that. And the other thing is, there is some truth to the fact that scale will help solve for COGS, that as you grow, you see that. But I think too many brands, too many founders sell themselves that concept as being too true, and don't always see that manifest, because the other thing scale does is usually drive down price point, because in your earlier days, you're usually at your highest price point. You're in the more specialty stores, and as you move more towards conventional and mass, there's more downward pressure. And as you become more ubiquitous in the market, there's more downward pressure. So that scale is just keeping you constant with margin. It isn't actually getting you ahead. So all those things should enter into it. And it should be a very, very important, well thought through aspect of strategy, not just something that you kind of feel compelled to do. And so if anybody ever wants to have that discussion, you all know where to reach me. Jenny has a question. Hey, Jenny, what's happening when hiring a bookkeeper accountant as a small brand with limited resources? What questions to ask to make sure they truly understand our industry before working with the big firms that we know and understand? I mean, the one question I always ask is, did you ever work for Bernie Madoff? That's a good first kind of icebreaker. But Heidi, any suggestions there?
That's a good start. That's a good start. With that, definitely you need to ask them, have they ever worked with a company that has worked with inventory? So you need to ask them multiple questions about have they worked with inventory? How do they treat inventory? What we see a lot with bookkeepers is whenever you buy your raw materials, or even when you buy co-packed units, it immediately goes on the P&L, and it doesn't belong there. It sits as an asset on the balance sheet until you sell it, and then you only recognize it for the units sold. That's a big one, to really spend a lot of time talking to them about inventory. And then the second one is, how much experience have you had with accrual accounting versus cash accounting? Because those are probably the two largest areas of cleanup that we see when we get a brand coming to us that really needs a lot of help and cleanup, because they're trying to raise funds and their financials are not in the right shape. So I think typically, if you spend a lot of time in those two categories, talking with them to make sure that they really understand food industry is important. But then if the third one, and it is harder to find someone that knows it, and so it's a matter of testing to see how much desire they have to learn, is trade spend. Understanding the contra revenue that we just talked about, and the trade spend, and how to record that properly, is really important as well. It's a lot harder to find a bookkeeper and accountant at an earlier phase that's done it. If you feel like you have a pretty good grasp on it and they're willing to learn, that I think that's very much a teachable piece of information. It's a lot harder to teach an accountant, nor do you have the time, and nor should you teach them accrual accounting over cash accounting, and how to do and manage inventory.
Yeah, and another question too is just ask them for the name of their parole officer. If they don't laugh and then they actually start, offering you a name, that's another kind of aha moment.
Yes.
But in all seriousness, there are enough brands in this space that you could crowd surf a good bookkeeper um, who understands the basics of this. But I want to draw a very, very distinct difference between a bookkeeper and a strategic accounting partner, because it's a very, very different thing. It's great to have a bookkeeper. A bookkeeper is helpful. They're taking things from your plate that aren't your highest value activities and getting them done, and they're making sure that things are going in the right buckets and doing those things. But they're not typically a strategic partner, in the fact that they're not trying to help you tell what the score is, help you understand what the score is telling you, and also helping you foresee what this current score means for the long term. And it's important to know the two. And one of the things that I see far too frequently is that brands they think they have real accounting, real CFO level type support on their team, when they're in fact just leveraging a bookkeeper. And when it comes to fundraising, when it gets to that level of detail, and you're having to really answer to your financials and you can't, that's where you recognize the difference.
Yeah, that's actually, just to add on to that, that is a really important piece, and I appreciate you bringing that up for sure.
That's
Um,
$5, right? That's what we agreed to.
exactly. Yeah, I've Venmoed you already. So that really is important, that the bookkeeper is going to be able to record the data in the best manner that they know, and that you instruct them. There's a lot more oversight in the bookkeeper, and they're not going to be able to really truly tell you the story of what your financials are telling you, and the accuracy. They're just kind of there's some amazing bookkeepers, but they're much more process oriented. When you start getting into a higher level strategic accountant or controller or CFO, that's where the accuracy of the data and the story of what your data is telling you really starts to unfold. And that is a lot harder to develop, when you just have that bookkeeper resource, unless you're pretty savvy in finance and that's a strong suit for you as well. But the other component is a lot of people in early stage brands are like, we're bootstrapping it, where definitely we have a small amount of cash that we can spend, and so we want to save money there, and we can. But what they don't understand, and that a lot of companies that we work with learn much later on, is you actually end up paying more in the long run, because typically when you get to the point of fundraising and scale where you need that true, finance and accounting, much more strategic, much more elaborate support and recording and things like that, in order to square away what happened early on when you were bootstrapping, instead of it costing you like a small amount of money, you're now in 4 times more than what you saved in going the cheaper route with a less experienced bookkeeper. So that's one lesson that I would learn as well, when you're comparing between an accountant that's a little bit more expensive but really has the background, the knowledge, and the skill, versus the cheaper resource, the bookkeeper. Don't just make it a comparison, make it on the individuals and what they bring to the table for a food brand, rather than about how much money you're saving. While I realize that's important, time and time again, it will in the end cost you more to go with the cheaper but not really experienced enough to be able to pull it off.
Yeah, and again, and I'm not just saying this for the $5 Heidi gave me. I'm saying this because it's true. This is a core part of building a business, and it is foundational to it. And if you don't have good accounting foundation, good strategic accounting foundation of your business, you risk building a business on a house of cards. And I've seen it. I'm sure, Heidi, you've seen it too many times, where it just happens and it falls in on itself. So there are places to be scrappy and be thrifty, and there are places to invest. It's the old adage, it takes money to make money, and you've got to do some things on. Got another question for us. This one from Asher Cowan. Asher, good to see you. Hope the whole fam's doing well. Is there an industry standard for advertising cost of sales for an e-commerce digitally native brand? Have you seen that?
Yeah. So the cost, you mean the cost of like affiliate marketing?
Well, I think, and Asher, feel free to type in here if need be, but I think what he's referring to is just as a percentage of e-com revenue. How is there a standard, or is something that you see about how much of it's reinvested in acquisition, to advertise,
Absolutely.
get business?
So e-com's an interesting model when you're really forecasting out and evaluating it, because e-com is kind of driven from the middle of the P&L. It is driven very strategically through marketing and advertising, and what your reach out is to your consumer base. So your revenue, what are your site visits? What are your cart visits? What is your conversion rate, can very much be heavily determined based on what's happening in marketing. What is the marketing strategy and the plan? So it's kind of hard to say, what is the best practice or the average or a range there for marketing in an e-com business, especially advertising, because it's just a matter of knowing when you're investing. I've seen e-com companies invest an enormous amount, like $60,000, $70,000 a month, like on Facebook and Google, like all of their social media, and to see very, little site traffic pickup. So it really is more a matter of when you choose to do, whether it's advertising or social media push or something like that, to get velocities off of your site up and going. you really have to be paying attention real time to what traction it's getting you. Did that increase your site visits? Did that increase your, are you doing a promotion where it's like buy one, get one free? Did it increase your cart value? Did it increase your conversion rate? Really paying attention to your back end metrics when you launch a strategy or when you do a push out of a big Monday morning social media push. Do you always see on Monday, Tuesday, Wednesday a spike and then a fall off? So it's really hard to say, is there a best practice? I guess the best practice is when you're doing the advertising, pay attention to what your back end data is telling you on your website as to how the market is reacting to what you're offering. What is it changing? What is it not? Is it not doing anything? Okay, now pivot and move quickly to be able to, recapture some of the spend that you've had and transition it to something that might actually work a little bit better. I think that that's the best way I can answer it, because that one is kind of similar to trade and where you are in the story. It's not a simple answer.
And I'll answer the same way I answered Lawrence. No, there isn't. It's very much all over the place. We don't have a ton of time left, so I'm going to take some moderator's prerogative and ask some questions I think are super important. One is, you've spoken to it a few times, but I don't know that everybody really understands the importance and what exactly is the balance sheet.
Yep.
So maybe just a very kind of 30,000 foot understanding of what is a balance sheet and how is it used?
Yep, absolutely. Okay, I will try to make this not something that will make people go to sleep. So you have three different sets of financial statements. You have your P&L, which shows your activity, your revenue in, your expend out. Then you have your balance sheet, which is it's your assets and your liabilities and how much money you have either put in or someone else has put into your company. The balance sheet is really important because the balance sheet really represents where you've invested cash, whether it's putting cash in the bank, whether it's investing it in assets, whether it's investing in assets being inventory, assets being fixed assets like any sort of machinery that you have, office equipment, whatever it may be. And then you have your liabilities. What are those? Those are the bills that have come in that you haven't paid. Maybe it's payroll liabilities. Maybe it's some loans that you have. And what the balance sheet, as those values go up and down, you could have something as simple as prepaid expense. Prepaid expenses, I had to pay for my trade show booth in September, but Expo West isn't until February. So I'm paying the cash out, but I don't want to put that on my P&L yet. This is where we get into accrual accounting. The balance sheet becomes really important in accrual accounting because we've spent cash, it's not in my account, but I don't want to put it on the P&L because you recognize something like that in the month that you do the trade show, not when you pay for your booth. So that's where you get the really lumpy financials. So where do I park that? Well, it's an asset because you've paid to have the opportunity to do something. So you park it on your balance sheet, your asset. It represents cash that you've spent or that you have spent that you'll get benefit later that's showing on your P&L, or it's an expense that you've incurred that you haven't yet paid. So it tends to be that representation of how have I spent money that hasn't really come through my P&L, except for in the equity section, because it comes back to you, your results of your P&L come back to you in your equity section of your P&L as either retained earnings from past year's results on your P&L or as net income that is what is the current year's results. The reason why the balance sheet is so important is because it allows you to understand how you've spent cash that isn't on your P&L yet, or do you owe cash that also may not be on your P&L. And that's where you get to really understanding, what is my obligation? Am I upside down from a cash perspective? It really then flows, it's that critical financial statement that really then lends to that further understanding of what is your cash position, what does it look like, both short-term and long-term. I hope I explained that. Balance sheet is hard.
It is a hard thing, and I sometimes I consider it just kind of like a accounting parking lot. It's where you put things that haven't been yet applied to some degree.
Correct.
Um,
But it can become the graveyard, and that's where you have to be careful. So you need to know what is actually on your balance sheet and why is it there and does it still belong there? Because I always say that that's where you bury all the bodies, because your balance sheet rolls forward year over year. It doesn't clear out. So anything that you've put on your balance sheet on accident sits there and haunts you forever until someone goes in and really cleans it up. So you really need to look at it on a monthly basis and make sure that you know what's in each account and that it's real and right. And that's the difference between a lot of times what the bookkeepers do and what controllers and the higher level strategic accountants do, is they make sure that there's no buried bodies on your balance sheet, because your balance sheet can also misstate your forecast of cash. If you've got a body in there that you don't know is in there and all of a sudden it comes out, you could be short. You could either have a surplus of cash that you didn't know, windfall yay, or you could not have as much cash as you thought. So for example, inventory.
yeah, and just FYI, it's typically the latter, not the former.
It is
Um,
very typically the latter.
I would also say, just in general, to everybody listening here, please make me a promise. You know, in this industry, regardless of which of the topics we're covering on a podcast like this, you know, we talk about things daily that almost become pedestrian. They just become normalized, including things like balance sheet and statement of cash flows and, you know, various ratios and, you know, all, and, you know, I know because I was there and I'm still there. There are so many of these things that we just kind of shake our head and understand, you know, pretend like we really understand. One of the things that you should always do when you're working with an advisor or a service provider or whomever is be vulnerable enough to ask them to clarify or educate you about a specific uh, element of what they're doing or what you're looking at, so that you increase your knowledge base and become a more critical consumer. There's no shame in it. There's no one. I've been doing this for over 30 years and I still spend far more of my life and my time as a student than I do as a teacher. There's nobody who knows every element of it, and you should never be reticent to ask the question and say, can you stop and explain to me what this is? Can you tell me what I'm looking at? And especially with something as fundamentally important as your numbers and your financials. So I just want to kind of, you know, encourage everyone to do that. Heidi, last question before I get, you know, your contact information and all of those normal pleasantries out of the way. And this one will have to be, because we're right at the top, but just kind of, you know, bullet pointed. Brands going out to raise, whether they're raising convertible notes or doing priced rounds, meeting with angels all the way up to institutional investors, what should they know they have ready in their suite of financial information, and what should they be versed on to be able to explain and speak to?
Well, the most important thing a lot of times is revenue. How are you forecasting your revenue? And how does that lead you to where you think you're going in your, you know, your financial forecast, your P&L, your forecast? How are you forecasting your revenue? They're going to really zone in on that. Are you going e-com? Are you going brick and mortar? How are you going to accomplish that? The second thing that they really want to know is, what is your margin? Because like trade spend we just talked about, you know, them understanding like how much money you're investing in your growth is going to be really important. And so they want to understand that your margin is large enough. And what I mean by margin, there's like 99 different ways you can look at margin. I call it manufacturing margin, which is before you add on trade spend, what is your margin to produce your good based on your sales price? How much percentage do you have left over to utilize in other ways? Because they want to make sure that you have a really strong manufacturing margin so that you can weather trade spend and still have plenty of money to invest below the line and selling costs and marketing costs and back office. So that's where it kind of comes back to really having that forecast, because you're going to walk through all of those baseline assumptions and really be armed and ready, because those are going to ultimately drive to the end number, which is how much am I asking for? Because how much you're asking for is going to discern what type of investment that you are asking for, whether it's convertible note or an equity round. But really putting thought into how you're raising revenue, how you're going to support that revenue with sales and marketing effort, and what is your manufacturing margin. That's really the questions you're going through to create your baseline assumptions on your P&L, on your forecasted financials at least 2 years out, so that you really know what your cash ask is. Don't start hunting for investors prior to knowing those things, because then if you not bait and switch, but if you switch on them because you put the thought in afterwards, that's the quickest way to shut those conversations down. So put your due diligence in on the very front end before you go out and start sourcing funds, and know what those numbers are, because those are probably the first 3 questions that they ask. And that puts you in a really nice cadence of forecasting and thought process strategically about your business.
I think it's amazingly good advice. And the only thing I'd add to it is that when you're ready, before you meet with investors, sit down with whomever you're working with on your numbers, or with an advisor or whomever, and hand them your financial packet and say, ask me the questions an investor is likely to ask me, and help me work through the answers and help me understand these numbers. Be the best, the most educated student of your own numbers before you ever meet with an investor, or before they ever go into your data room and start looking at your information. And if you don't, ask, the people around you to help you become conversant in them, because that's the thing that investors look for too, is that these numbers aren't disconnected from you, and you're not disconnected from them, that you are as much an author of them as you are as the person doing the actual books or strategic accounting is. This was awesome. We're out of time. We could talk about this a lot. Hopefully we put a lot of people to sleep as well. So we've done, a double duty here. If people want to learn more about AVL Growth Partners and you, what's the best way, Heidi?
The best way is you can email me at huntington@avlgrowth.com, or you can just go out to our website, AVL Growth Partners, and learn all about the different industries we work with, and more about, what we do and the different brands we've worked with. But
Awesome.
anyone can reach out to me and email at any time. Even if it's just for basic questions, more than happy to share some knowledge and keep things going for you. And it was such a pleasure to be on today. So I appreciate you having me.
No, my pleasure. Thanks so much for taking the time. And everybody, thank you so much. Hope you get some valuable insight from this. And again, all of the information, as well as Heidi's contact information, will be in the show notes. And look forward to seeing you soon on another TIG Talk. Thanks so much, everybody. Bye-bye.
Bye, everyone.